afternoon, everyone. Welcome to Connection from Baroda BNP Paribas Mutual Fund, the webinar on Union Budget 2023. My name is Siddharth Singh. I'm Head of Products for Baroda BNP Paribas Mutual Fund. And today I'm delighted to welcome our esteemed panelists to this discussion on the Union Budget. Let me first introduce them briefly. First of all, we have Mr. Madan Sabnavis, who is the Chief Economist at Bank of Baroda, one of our sponsors. He's a postgraduate in economics from the Delhi School of Economics and graduated from St. Stephen's in Economics Honours. He has been a corporate economist since 1987 and has worked in the fields of development banking, commercial banking, engineering, and commodity markets and credit ratings. He has multiple interests in human behavior, politics, and social systems besides economics. In his personal capacity, Mr. Sabnavis has published more than 2,500 articles across financial publications since 1988. And it's also a published author of 4 books, which are Macroeconomics Demystified. The second one is Economic Quirks. Then Economics of India, How to Fool All People for All Times. And finally, Hits and Misses, the Indian Banking Story. Mr. Sabnavis is also a member of SEBI's CDAC and RAC committees, IIB-EF's RAC committee and Education Committee. He has also been chairman and co-chairman of committees of BCCI and IMC. Our second panelist is Mr. Prashant Pimple, who is the Chief Investment Officer, Fixed Income at Baroda BNP Paribas Mutual Fund. He heads the Fixed Income Investment team. Prashant has more than 22 years of experience in financial services and investment management. Prior to joining us late last year, Prashant was CIO Fixed Income at JM Financial Mutual Fund. Earlier, he has also worked at Nippon India Mutual Fund for over 16 years, and prior to that has been with Fidelity, ICICI Bank, and SIDBI in the early part of his career. Finally, we have Mr. Sanjay Chawla, who is the Chief Investment Officer Equity for Baroda BNP Paribas Mutual Fund. He has the equity investment and research teams. Mr. Chawla has over 33 years of experience in fund management, equity research, and management consultancy. He has served as Chief Investment Officer with the erstwhile Baroda Asset Management, which merged with BNP Paribas to form Baroda BNP Paribas Asset Management. Thank you all, gentlemen, for joining us in this discussion. Just to get the ball rolling, just a brief context. According to the Economic Survey for 2022-23, the economy appears to have moved on after its encounter with the pandemic, staging a full recovery in FY22. And it's on the path to achieve its expected to achieve its pre-pandemic levels in FY23. Yet, in 2022, India also faced the challenges of inflation, which were accentuated by the Ukraine crisis and the resultant volatility in global commodities, especially oil. Inflation elevated for most of 2022 seems to be trending downwards in India now. The pressure on the rupee brought by a globally strengthening US dollar, however, continues as the US Fed has continued to hike rates, albeit at a slower pace. Now we had a 25 bips hike yesterday. The widening of the current account deficit may also continue as global commodity prices remain elevated and the growth momentum of the Indian economy remains strong. Despite these challenges, the Indian economy is expected to grow at about 7% according to the Economic Survey in 23 and about 6.5% to 6.8% in FY24. The resilience of the Indian economy, and I think this is something that Sanjay will talk about later, is mainly on the back of private consumption. The global economy also in 2023, according to the IMF and its recent publication, has started to look up and look somewhat less gloomy than it was perceived to be, say, even about 2 months back. The Union Budget was presented in such an economic context. And now we will turn to Mr. Madan Sabnavis for his thoughts on the Union Budget. Over to you, Mr. Sabnavis.
Thanks for having me here, and good afternoon to everyone. When I look at the Union Budget, the first thought which comes to me is that as an economist, what I feel is that we did tend to blow up the budget during the pandemic time. It was necessary. And lots of people felt that we did not do enough. Because if you looked at what countries like the UK, the US did, they actually handed over cash, gave tax refunds to almost every household, irrespective of whether you were in the richer group or the poorer group. Whereas India was a bit more, very much more conservative. and what we had, the Atmanirbhar schemes which came out, there were more of policies which were spoken of, lots of them implemented in course of time. But we were very, very conservative when it came to drawing up the budget. So what we really did was that the government looked at sectors which were very vulnerable, like, for example, farmers, the poorer people. So therefore, we had certain schemes which were devised for them, like the free food scheme, which has been largely popular and it has sustained a large proportion of our population. That's what the government says, that almost 800 million people had benefited from this particular scheme. Similarly, when they looked at the plight of the SMEs, there was the ECLGS scheme which was announced, which was implemented through the banking system. So that was something which helped this particular segment. And so therefore, it was very much targeted spending by the government, targeted schemes. So rather than saying we give cash to everyone, I reduce my income tax for everyone, they actually looked at the vulnerable sections and accordingly did it. But notwithstanding this conservatism which was shown, we still saw that the budget got exaggerated, numbers increased, spending increased, the fiscal deficit ratio increased. And last year, before the budget was introduced, we had a new FRBM path which was charted out. And the path was basically to say that the fiscal deficit ratio should be reduced to 4.5% by fiscal 25-26. So I think when this budget was to be announced, our main concern was that will we walk the path of fiscal prudence, or will we give in to populism? We say populism because this is the last full budget before the elections, which come up in 2024. Populism, of course, is a very, very loose term used. I would not actually go with it, because helping the poor is not populism. But that's the way it has been interpreted. That will there be a lot of free money given, easy money given to various people so that you'll be able to garner more votes? That's normally what populism is. So it was a very pleasant surprise, not unexpected, I would say. So I'll say it's an expected kind of a surprise, because I felt that if I look at the ideology of this government since 2014, it has been focused a lot in terms of fiscal consolidation, spending meagerly, spending only where it's required, no extravagance shown anywhere. So I was really not expecting too much of easy money to be given. But still, there was always a case of saying that this is an election 2024. The NDA is going to hope to get the third time come to power. So there could be some extravagance out here. But true to its nature, I think we saw that there was no such announcements made. And the starting point of the budget, where I would like to conclude my initial remarks, is that fiscal prudence is important. So therefore, to reduce the fiscal deficit from 6.4 to 5.9%. So we still have 1.4% to cover in the next 2 years, which means we have to be more aggressive in future. They could have targeted 5.5% also, but they have not done it, because in an environment where economic growth is supposed to slow down, as the economic survey says, 6 to 6.8%. We at Bank of Baroda have always maintained 6 to 6.5%. And mind you, we have been the outliers, because all my colleagues, economists and other organizations are actually looking at numbers of 5 to 5.5%. But our analysis showed that 6 to 6.5% looked very much feasible. So we felt quite happy when the IMF said 6.1 and the government has come up with 6 to 6.8%. So when the economy is slowing down, it may not make too much of sense to boldly project a number of 5.5%, which may not be achieved, because GDP growth number is important, because that number forms the base for all your tax projections. So whatever has been projected, it has been very, very realistic. There could be an upside, no, not a downside. So I think that's the big positive we have. So I think the whole budget, to my mind, has been built on this edifice of lowering the fiscal deficit ratio in a meaningful manner and making money work better, which we can discuss later when we talk on other aspects. Thank you.
Siddharth, you're on mute.
Sorry. The perils of online webinars. So sorry about that. Now we move to Sanjay for his opening remarks, for his thoughts on the budget and its impact on the equity markets. Sanjay, over to you.
Thank you, Siddharth, for having me on the panel, and good afternoon, everybody. Before talking about my views about the budget, I would like to contextualize the backdrop under which the budget was presented. Just as Madan did mention, this being the penultimate budget before the general election, there was an expectation that this would be a very populist budget. From a capital market perspective, there was a lurking fear that the capital gains tax would be modified for either for duration or for the rate. Finally, the last 13 budgets, including all the interim budgets that we've seen, 1 week prior to the budget presentations, the equity markets had fallen on account of nervousness on the budget. This time around too, the equity markets fell by about 2.5%. However, we can debate what the current fall was on account of the nervousness of the budget contagion or the contagion effect on the fall of the group of companies belonging to a particular group. In the above backdrop, I am positively surprised. The budget turned out to be nothing close to being an election year budget, but was refreshing in its equitable assumption and focus on investments, a throwback to the traditional economic principles. I have 6 or 7 key takeaways from the budget. Point number 1, I think the focus on the infra spend. I think all the newspaper headlines have already been talking about the same in terms of the percentage increases and the actual quantum. Let me not overwhelm the audience with these numbers. We can talk about specific sectors during the Q&A. Secondly, I think this is something that Madan has also alluded to. This is a realistic assumption in terms of the fiscal assumption. The nominal GDP growth is assumed to be at about 10.5%. I think the actual number could be higher. The revenue collections are based on these nominal GDP assumption and hence can have some potential upside out there. Number 3, which is it talks about whether we're going to achieve the fiscal deficit of 5.9% in the current scenario. I think, and of course, the prudence or the FRBM Act, which talks about a glide path to come down to 4.5% by FY26. I think that's something which is pretty commendable. And I'm actually looking forward to Madan's view in terms of how would the rating agencies react to this kind of a fiscal deficit that we are really talking about. The capex spent is not only directly in certain sectors like the railways, etc., but the center is also encouraging the states to spend and incentivizing the state by offering them interest-free loans. This could lead to some more power sector reforms, which is very much in need out there. The fifth point is, which is a little disappointing for some, the Manrega outlay is a little more tepid compared to what was the expectation or the hope was. Historically, we've seen from a stock market point of view that whatever Manrega was spent, it was resulting in direct consumption on the rural side. We believe that the capex spend, especially on the rural side, is likely to have a much more higher multiplier effect. And again, maybe Madan could actually help us decipher if that's the way it's going to pan out or no. Finally, the sixth observation that I have is there seemed to be some kind of a stimulus by giving higher allocation to certain schemes, which may jumpstart the rural demand, especially on the staple side. Hopefully, the capital spend on these rural projects would lead to some kind of a sustained demand from the rural market. And finally, that's the seventh takeaway which I have. No news on the capital gains tax is good news. The only negative that I could really find from the equity market perspective was potentially lower increase on the defense spend. So those are my broad 6-7 points on the budget, which I believe could impact the equity market. And of course, the insurance side is something which I think we've already seen an impact on most of the insurance companies. Yeah.
Thank you, Sanjay. Thank you for those insights from an equity perspective. And now we have Prashant for his take on the budget and from a fixed income perspective. Prashant, over to you.
Thank you, Siddharth, and good afternoon, everyone. So from a fixed income perspective, clearly we think that this was an expansionary budget with thrust on investments and consumption both. But along with that, one important thing which I think the market cheered about is the assumptions were very, very realistic, be it GDP or be it expenditure or be it revenues. I think numbers both Sanjay and Madan has already spoken about, but the numbers were quite realistic. In fact, on the fiscal consolidation path, which is very important from a fixed income perspective, is they have adopted the consolidation path with your fiscal deficit around 5.9% from 6.4%, and as discussed earlier, they will go towards the path of almost 4.5 in next 2 years. So from numbers perspective, it was really a great budget. In fact, just before budget, when capital expenditure was talked about, which was slightly more as compared to last year, we saw yields going all the way up to 740 on the 10-year benchmark. But as the numbers on gross borrowing and net borrowing were out, which was in line with the market expectation and almost close to last year, we saw markets reacting very, very positively. In fact, cheering it a lot by dropping by almost 10 basis points. I think in near term, the most important thing for market to follow is the policies, both Fed policies and the RBI policy. Fed policy is already out. In fact, we saw Fed hiking rates by 25 basis point yesterday. And they have reduced it from say 75 to 50 to 25. So it's a slower pace of rate hikes, which gives us some amount of confidence as far as Reserve Bank of India is concerned. And I think as we go ahead next week, I think we will be clear about what our MPC thinks about the rate policy going ahead from a Reserve Bank of India's perspective. Thank you.
Thank you, Prashant. Thank you for your insights. Just a reminder to everyone, if you have any questions, you can put it in the chat box that would be appearing on your screens, and then we would be taking up as we go along. So now we go over to the more interactive part of the discussion. We'll open with Mr. Madan Sabnavis. Yeah. So, Mr. Sabnavis, I think the first question is, I mean, you did allude to the fact that the economic growth is slowing down. And do you see the budget and realistic in terms of its assumptions as far as nominal GDP is concerned? It talks about a 10.5% nominal GDP growth, and real GDP growth of about 6.5% is what they're expecting next year. So is it realistic that inflation would be in the 4% band, and I mean, therefore the other numbers as well?
Yeah, so actually, if we just go back one day before, I think the economic survey spoke of nominal GDP growth of 11%. It's not mandatory that what the economic survey says is used in the budget. In fact, the two documents are drawn up separately, so there's no reason why one should know what the other one is doing. But what the budget seems to have pitched for is a more conservative number of 10.5%. So I think 10.5% is definitely on the lower side, I would feel, in nominal terms, because I'm looking at a real GDP growth of 6.5%, and inflation definitely above 5%. So I would be expecting a nominal GDP growth of 11 to 12%. Now, whenever you're drawing a budget, we should just know that it's not an exact science, yeah? Because everything depends upon how the economy is going to perform, on which you actually have no clear idea. Because nobody knows whether we're going to have a drought, there's going to be an El Nino developing somewhere, whether there is going to be crude oil prices are going to go up, whether exports are going to come down, whether they will go up. We really, really don't know what's going to happen. In fact, if you remember, if you just go back 3 months, we all felt that it'll be hard landing, deep recession. Now people are saying it will not be a deep recession, it's going to be a soft recession. We're talking of actually positive numbers of growth in the Western economies. So in this kind of conditions, I think it's always better to be conservative, because if you're conservative, you're able to draw up a more realistic budget. And if things turn out to be positive, then well, everybody's going to go home smiling. Like, for example, if you looked at 22-23, everybody says that, look, the budget again assumed GDP growth of around 11. We ended up with over 15% growth. Now, this happened because of fortuitous conditions, because we had high inflation. So even though my real GDP growth did slow down compared to the previous year, but very high inflation, that is a GDP deflator. So just for the sake of the audience, let me clarify that when we talk of this inflation, it's something which we call a GDP deflator. It is not the CPI inflation, it's not the WPI inflation. It is a derived number. So when we say it's 10.5%, at the end of the day, if I end up with 6.5% growth, then the deflator becomes 4%. It's called the GDP deflator. So if one is trying to find congruence between this deflator number and the CPI and WPI, one will never get the same answer because it's a derived number. So in this kind of condition, we did see that the tax revenues did get a big boost because of high inflation. We saw consumption go up, not because we were consuming more physical goods, but because the value of the goods went up. So therefore, the GST collections were very good. So that's how we saw that a budget which was targeted around 39.5 lakh crores finally became something like 41.5 lakh crores in the revised estimate because my revenues actually saw an upsurge on account of the GDP numbers getting inflated. So I think it's always better, and that actually gave space to the government to continue giving more money on food subsidy, more on fertilizer subsidy, and still retain the fiscal deficit ratio at 6.4%. In fact, even the NREGA program was much higher than what was budgeted. So all this was possible because of the buoyancy which came because the GDP growth number turned out to be better. So I suppose even this year, I think as a matter of prudence, it makes sense that you be conservative so that you don't overstate your revenue and start spending and then suddenly realize at the end of the day that something is wrong and my deficit is going to go for a toss. In fact, if you look at most of the state governments, they have the same problem because unlike the center, which doesn't really have a gun put to your head to say that your fiscal deficit cannot be more than 5.9%, for the states, you're not allowed to exceed the limit of 3 or 3.5%. If you are going beyond that, you have to borrow. For that, you need to get special permission from the RBI and the center. So therefore, the states are very much cognizant and they're very fearful of spending. So what they do is that they don't spend on capex because capex is a discretionary spending. So if the revenue doesn't increase, like what happened during the pandemic time when the GST compensation was not there, I mean, there was no money to give to the states, then they cut back on capital expenditure. So it always makes sense that you drop a realistic budget based on conservative growth numbers so that you don't have to get into this awkward situation of cutting back on certain expenditures in order to meet the deficit targets. Therefore, I think the number of 10.5% on the lower side is always welcome. It's a better way of doing it rather than projecting 12.5% or 12% and suddenly you realize that things have gone wrong somewhere and then you'll have to cut back on expenditures during the course of the year.
Okay, thank you. Also, I think it's prudent to be a lot more realistic and probably under-promise and over-deliver as opposed to the other way around. I think that always helps all the stakeholders in that sense. Now I think the second question is on the big headline number that I think Sanjay alluded to, which was the capex of 10 lakh crores. Now that's a good big round number, and it's about 33% higher than what was announced last year. So how do you see the capex plan of the government? I think most of the largest chunk would be taken over by defense, roads and railways. And given your experience, what are the execution challenges that you foresee in spending this large an amount? I think there is some chance that we would be undershooting the number that we put out last year as well. So what are your thoughts on that?
So whom are you addressing? Is it
yeah.
Okay. Actually, when we're talking of capex of government, again, I would like to put on the table a certain way of interpreting it. When we're talking of 10 lakh crores, we should remember that 1 lakh crores is actually a transfer which is given to the states in the form of a 50-year loan, right? Which carries an interest-free loan. So when the state governments in their budgets show capital expenditure, it will include this 1 lakh crore. So we have to be a bit careful while interpreting it because they shouldn't be double counting, because normally if you look at the capex of state governments, it's almost comparable to that of the center. So if the center targeted 7.5 lakh crores last year, they again had 1 lakh crores which was given to the states, which is 6.5 lakh crores. So 6.5 was also the amount which the states have targeted. So almost it's a 1:1 which happens here. Now the second part is that will the capex target be met? I think the government has shown good resolution in the past and they have delivered fairly well. So what you mentioned is right, 7.5 became 7.3 lakhs in the revised estimate. So there was a slight shortfall, but that will always happen because of the way in which the accounting is also done. Because another interesting feature is that budgets are based on cash basis, right? So if I don't spend the money, it's not accounted for. Whereas as corporates, we have the accrual basis, and if I have not actually paid the money, but I have accounted for it, I will be treating it as expenditure. So I think this 20,000 crores will of course not be a significant amount, and even maybe for this 10 lakh crores, finally we may also end up around 9.5, 9.6, which doesn't make too much of a difference. But the way I look at this capex of central government is that we should not feel it's a panacea for all the problems on investment, because in India, investment has to come from the private sector. Okay, if I look at the total amount of gross fixed capital formation in the economy, so today, for example, we're talking of a GDP of around 300 lakh crores. So if I'm talking of 30% as gross fixed capital formation, I'm talking of total investment of 90 lakh crores, which has to be made in the current financial year. So look at this. I'm talking of 10 lakh crores or maybe 9 lakh crores if I adjust for the states, because the states will also bring in another 9 lakh crores. It's only going to be a proportion. The center is actually contributing to maybe 10, 12% of overall investment in the economy. So therefore, to say that this number of 10 lakh crores is going to accelerate the economy will be a falsehood. We should not live in this illusion that 10 lakh crores is going to drive the economy. It has to be done by the private sector. Second, I think almost every person who's come on TV, every person who's written in the newspapers has said when the government spends, there's crowding in of private expenditure. Okay, private sector crowds in. But why has it not happened for the last 10 years? From 2013-14, we have seen the gross fixed capital formation rate, which is the aggregate investment rate in the economy, has come down from 33% to 26%. Today, we're in a region of 27 to 28%. So I'll give you a reason for this. The reason is, if I'm a private sector company, I will invest only in case I'm able to get my ROA has to be positive, my return on equity has to be positive. When the government is investing, it doesn't bother about profitability. It does it because it has to do it, because nobody else builds a road, I build the road. Now, the reason as to why the private sector is not investing is because we have a fundamental problem of demand in the economy. This was there even before the pandemic. So if there's shortage of demand, I have surplus capacity utilization, in which case I don't have to invest. So some sectors like steel are definitely investing. They're operating at more than 100% capacity utilization. Cement is coming close. Some companies are coming close to 100, so therefore they're investing. Typically, if your capacity utilization rate is 80% or more, you go in for fresh investment. But if you look at all the consumer goods industries, we don't see too much of fresh investment coming in. The reason is simple, because demand has been lackluster. Demand has been lackluster because consumption is down. Consumption is down because income is down. Income is down because not enough jobs are being created. So I think that is the fundamental problem which is there, which cannot be solved by the budget. It cannot be solved by the government of India. It has to happen in the private corporate sector. And it will happen in the corporate sector in a slow and a gradual manner. We are seeing certain amount of traction in certain sectors, but definitely it is not generalized. So in short, what I'm saying is, when you look at this 10 lakh crores, don't expect it will definitely move the needle, but it will not raise the needle. Maybe from 0, we'll go to 10 kilometers per hour, but are we going to go to the second gear, third gear? The answer is no. For that, we need to have the private sector do it. And the private sector will do it only when they see profits. So that's the reason industries which are linked to infrastructure have shown better investment. So even if I look at the 6 monthly results which came out, where you provide the balance sheet and see where have the GFA increased, it's been basically in the infrastructure related industries. It's happening in oil, refinery, gas, steel, power. But if I look at FMCG, the answer is no. Is it happening in pharma? It happened earlier, it's not happening now. So we have to be guarded when we're interpreting this number. This number is very good. The government has done all that it can, given the constraint of fiscal prudence, which we're talking of, but it cannot be the engine to growth. It has to be the private sector, even including for job creation. Mind you, even when you say is this a job-oriented budget, the answer is no. I have provided the requisites. Employment actually takes place in the companies which are producing the goods. If they don't produce, they don't employ more people, we will not be able to create the same kind of jobs.
Thank you. So as you say, it moves the needle, but probably doesn't raise the bar as far as investments go. For that, the private sector needs to step up. I think we'll come to that in a bit again, I think, as part of the discussion. Now, I think we move over to Prashant. Prashant, the government has announced a marginal increase in the borrowing program. This coupled with the limits on small savings going up, so there is some expected to be some small savings mop up as well. The government is also talking about investment. I mean, it's a major capex cycle. Though Madan did mention that it probably is not enough, but it is still larger than what it was last year. So in that sense, it is a major increase. So how does the debt market look at these numbers? I mean, the government's borrowing program talks only about a marginal increase in the borrowing. So is the market believing what the government says about borrowing and fiscal prudence?
Yeah, on the face of it, when you look at capital expenditure, in fact, the number of capital expenditure going up by almost 30% was announced first, on which the market reacted negatively. But once, as Madan said, the clarity came in on that and the borrowing numbers were out, I think market took their own comfort and rallied further from 740 levels. From a borrowing perspective, clearly market was expecting around 15.5 to 16 trillion. So it is around the expectations. And when you look at the assumptions also in arriving at these numbers, they seem to be quite realistic as far as markets are concerned. But when you look at the absolute number, say, for example, 15 and a half on GSEC front and another, say, 7-8 lakhs on the SDL front, put together 24 lakh crores of borrowing in next financial year. Somewhere I feel, though the market has rallied, I might be proven wrong at this point in time. But clearly, I see that this is a good amount of large borrowing, which will keep us anchored around the current levels for quite some period of time. So I don't expect that this rally in G6 is going to continue for very long, because when actual supply starts in April 23, that's when we will start looking at the demand supply dynamics playing into the hands of the market, and accordingly different parts of the yield curve will adjust itself to the fresh supply.
So what do you expect? How do you expect the RBI to react in these circumstances? I mean, do you see it
in the policy, you mean?
Yeah, not just the policy. I think a longer term view going forward as well. I mean, you expect it's a large borrowing program. You expect rates to stay elevated. I mean, am I correct in that assumption?
So, couple of things. In fact, next week, next Wednesday, we have RBI monetary policy in light of budget and both FOMC, that is policy by Fed. I think looking at both these things, even RBI would be doing 25 basis point of rate hike, taking the terminal rate to 6.5. And when you look at a terminal rate of 6.5 and expect that 6.5 is there to stay in this market for some time, expecting that there will be a continuous rally at these levels and markets are discounting a lot of things, it's very difficult to digest right now. Hence, I feel with 6.5 kind of terminal rate, at least we will be hovering around 7.5 on the 7.5 on the 10-year for quite some time. Along with that, even if you look at the liquidity situation or you look at the demand supply situation, which I just spoke about, then you look at your terminal rate kind of situation. I think all these things will warrant to some kind of stable interest rate or a range bound interest rates over next couple of quarters. Post that, I think news like if RBI wants to ease out some bit of liquidity through open market operations, or there is a bond inclusion of Indian bonds, then probably you might get some comfort and you might see some rally, which would be in second half of next financial year, I feel.
Very great. Thank you. Now, Sanjay, I think over to you for the equity markets. So I know we've talked about the 3 C's, credit, consumption, and capital expenditure. And capital expenditure is something that both Madan and Prashant also talked about in the earlier pieces. So what do you think, what sectors would benefit from the budget? What's your reading?
Yeah, so I do acknowledge the point that Madan made, that there is a little bit of a double counting in terms of capex, but and that the private sector is not really kicking in their full weight. I believe part of the reason is, of course, because of the capacity utilization, which is still hovering below the threshold before which the private sector would start expending in terms of capex. Clearly, on an incremental basis, we are seeing increase on the capex spend, which would mean that there would be buoyancy in this industry or this sector. And the sectors that I would really look at is RRR. And I'm not really referring to the internationally acclaimed movie, but I'm referring to railways, roads, and the rural side. The higher budget allocation to these sectors should see the biggest flip in terms of the order book for the companies. And when we look at the sectors, we do not look at only the direct beneficiaries, but also the indirect beneficiaries. We expect the entire value chain of capex, whether these are the engineering companies, the contractors, the steel companies, the cement companies, the infra financiers to benefit from the capital spend. All these sectors. The cut in the IT slab for individual taxpayers should help the consumption only at the margin. I don't think it's a big game changer, but it's marginally positive only. I'm actually hoping that the boost in the consumption may come after the capex cycle has played out. This can have a much bigger multiplier effect and boost the consumption demand on a sustainable basis, provided it pans out the way we are looking at it. Defense outlay seems to have got only a marginal increase in the current budget, which the market seems to be worried about. I had an interesting observation about the same. Even if you look at the current fiscal, we have seen the order book, at least for the listed defense companies, to be increasing much more than the actual defense outlay that we've seen in the last fiscal. The current outlay that we've seen is about 8%. And I'm hoping that given the fact that the government has two major programs, whether we call it the Atmanirbhar program or the offset program, the actual defense orders for these listed companies is higher than 8%. So those are the key sectors that I would actually look at, which have got impacted. I'm not really referring to the insurance companies, which have got negatively impacted, which I believe, insurance is a product which should be used as an insurance and not as a savings vehicle. And that's the loophole that the government is trying to plug in. Yep.
Okay. Okay. So, given this,
Siddharth, if you don't mind, Siddharth, if you don't mind, I'd just
Yeah.
like to add, see what Prashant was talking in terms of liquidity. I would fully agree with what he's taking about in terms of stability in bond rates and talking of something in the range of 7.25 to 7.5. But I think one nagging worry is, of course, the state of liquidity in the market. So, there was a time when we spoke of surplus liquidity, 6-7 lakh crores per day. Today, we've come to virtually nil. Okay, so I think there has to be some kind of measures taken by the RBI to enhance liquidity. And I'm sure the RBI is cognizant of it and will be reacting. But so there could be a bit of volatility, especially in the short-term yields. So what we have seen is there's always this anomaly when it comes to it. I think even yesterday's treasury bill, the yields the cutoffs are quite high. I think the 364 day went at 6.97, if I remember right. So this kind of thing is going to continue because I think as long as there is squeeze in liquidity, there will be the shorter end is going to keep moving up, whereas the longer tenures will remain stable at 7.3 or so in the short run at least. So I think we will have to live with that for some more time. Then to what Sanjay was talking of in terms of sectors, I think one quick way of finding out which sectors are actually growing is look at the growth in credit to different sectors. So if I look at manufacturing, large manufacturing, it's still in 2% over March. So what is really happening is more the retail credit is growing. So that's where people are borrowing. We are seeing the service sector borrowing. You look at a corporate bond market, 70% of the borrowings are coming from the NBFC sector, financial sector. So it goes back to saying that only the infrastructure related sectors are the ones which are borrowing in the market. So you have metal companies borrowing, chemicals are borrowing to a certain extent, but we don't, auto is borrowing to a certain extent, but we don't see it broad based. So I think this pattern was noticed for the last 2 years. I don't know if it's going to change next year. Let's hope if what Sanjay is saying is true. And we will see a more broad-based kind of recovery in terms of consumption, which immediately gets reflected in terms of growth and credit.
Okay, great. Thank you, Madan. Sanjay, so given this context, how are you positioning your portfolios, or how would you position your portfolios as the budget gets debated and passed over the next 2 months?
So that, our basic thesis has been on 3 Cs. That's your capital expenditure, credit offtake, that's the banking and the consumption. As a house, we've been overweight on the capital goods sector. Post the budget, it reinforces our view on the entire value chain. It would be worthwhile to start increasing our weight in some of the sectors like cement, the contractors, and even maybe the metal names that we've been underweight on. We have been underweight on the staples because of the higher prices and the weaker demand from the rural side. The fall in the soft commodity prices should provide us the margin comfort in the coming quarters. We shall monitor the volume pickup in the coming quarters, and especially post the monsoon, that it could actually reaffirm in terms of where the whole thing is panning out. We continue to maintain a significant overweight on the banking sector and have almost cut our underweight position on the IT sector per se. These are a broad positioning of our funds all across.
Okay, great. So now moving to Madan. I think the current budget just seem to be talking about fiscal consolidation, but I think the external sector has been a bit of a worry. Current account deficit has been increasing and it continues to pressure. And besides, the US dollar also has been strengthening against almost all global currencies, and we are no exception to that. So, what do you think of the your views on the external sector, and the second is obviously the impact on our currency? Where does the bank see the currency going?
See, the external sector is going to continue to be under pressure. So item by item, if I look at my current account today, when we're talking in terms of a slowdown in the global economy, maybe a recession, it will directly affect our growth in exports. So we have already seen in the third quarter, exports have turned out to be negative. So this kind of a negative growth or slower growth, if the base effects could probably still give me a positive growth next year in certain quarters, but definitely there will be a tendency for exports to grow at a slower rate, if not decline. On the other hand, if you're saying that the Indian economy is the fastest growing economy in the world at 6.5%, it will also mean that the demand for imports will keep increasing, which means that the trade deficit will intuitively be widening. Now, what happens on an invisible side? So far, we have been proved wrong in terms of our software exports, which have been very, very buoyant. But will this really last for another year or so? We really don't know. So if I go by what the economic survey is saying, it has not given any number, but it has definitely flagged a concern that a current account deficit will continue to remain high. So we were actually looking earlier at a number of 2.5% to 3% for next year, 3.2% for this year. But we may have to revisit this number. Maybe we may be closer towards 3% in the fiscal 23-24. Now, having a current account deficit per se may not be bad, provided I have very good capital inflows coming in. Now, on capital inflows, what we have seen is that ECBs today may not be as attractive as they were earlier because A, I have rupee volatility, B, interest rates are going out outside. So therefore, I may not be getting it. We have seen that notwithstanding the measures which the RBI took to attract more NRI deposits, that quite hasn't happened. So therefore, we're not getting too much from that side, which leaves us actually with the foreign investment flows. FDI is a more reliable source. I'm not quite sure what the number will be, but the trends are that 22-23 will be less than 21-22, which means that 80-85 billion which we've gotten may at best maintain it. We may not be able to go towards that 100 billion mark. The same thing about FPI. See, FPIs have been very whimsical, positive 1 month, negative 1 month, sometimes into equity, sometimes into debt, sometimes away from both of them. So can we really rely on FPIs? Now, I'm not quite sure. Maybe Sanjay will be in a better position to talk about whether FPIs will continue to invest in emerging markets, because today we have a situation where Federal Reserve has probably indicated that they're not going to lower the rates this year. I think that's the definite statement made. But we may definitely not be having further increases, or maybe mild increases. We may reach the number of 5% and then probably stop. And the fact that there's a recession, will foreign investors continue to invest in developed countries, or will they look at emerging markets? So I'm not quite sure whether that could be a positive for us or will it remain negative. But we should remember that when you're talking of quantitative tightening in the West, it means there is a lower corpus of funds which can be invested. See, a large part of the benefits which the emerging markets got post Lehman crisis and quantitative easing took place is that because easy money, free money was given to investors, what they did was instead of using it to revive their own economies, they invested it in the emerging markets. Now, I'm not quite sure with quantitative tightening, higher interest rates there, but probably no further increases, but recession still very much in these countries, whether the investors may choose to come to India or not. So on balance, I think there will be some pressure on our external account balance of payments. Fundamentals will dictate that there will be a depreciation, but it's not going to be a scary depreciation because the US dollar to euro or will continue to remain, the US dollar will continue to weaken. Not significantly, but maybe 1.07 to 1.08, 1.09 per euro. This will really mean that the rupee will probably depreciate by around 2 to 3%, which has been the trend depreciation. Now, just to share the view, there are certain economists who feel the rupee may finally appreciate. I don't go along with that view, but there's a view which says that the rupee may go below 80, we may go to 79 to 79 and a half. But I still believe that 2 to 3% is our view, our house view, but there will be this kind of depreciation. And the last point out here, there has been certain talks, I think, of having rupee trade with countries. I'm not too confident about how that will work in order to stabilize the currency, because wherever there is rupee trade, it may remove the demand for dollars. But finally, we should remember that nobody is willing to hold on to rupees. So if I give it to Russia, Russia may not know what to do with the rupees which it has. And I have a deficit with Russia. So maybe I can match my exports with the imports and the two things will balance out, which will not really affect the overall foreign exchange kitty which I have. Because if I'm not getting dollars, and I'm paying in rupees, I'm also not getting. So we should keep that in mind, that rupee trade, again, is not a solution. It will make sure, okay, if two countries are willing to deal in local currencies, we will be able to carry on without having any demand on the dollars and the currency rate.
Great. Now, I think that's a question. If you were to put, Madan, to you, so if you were, say, to put the RBI Governance Act, and given the circumstances that we are in, so what would be your stance on rates? And then I think I will come to Prashant to take a view on those.
No, I think I would agree with Prashant that there will be another rate hike which will happen, 6.5%, and then there'll be a long pause. Why do I say long pause? A long pause is probably what is required because we're not quite sure about how inflation would pan out in future. Prima facie, it looks like that we may be gravitating towards a 5% level. But if I look at the components of inflation, if we look at the core inflation part, looks very much sticky at over 6%. And reading the commentaries from all these investor presentations which are being put up, even after the third quarter results, most companies are saying we have not passed on the higher input costs fully. We are in the process of doing so, both services as well as manufacturing. So this gives us a sense that core inflation will remain around 6%. If I'm going to come towards 5% mark, it's because of food prices coming down, but food prices can also go up. This time we escaped the onion crisis. Normally every year prices of onions go up and inflation goes up. This year we didn't have this phenomenon. Last year, after Ukraine war, we saw wheat prices have gone up. So food prices could go up either way. But so I think the RBI will be a bit cautious. They will wait to see whether inflation has really come down to tolerable levels before it thinks about reducing interest rates. So at least for the first 6 months, view will be that no change, pause after a 25 basis hike in repo rate in February.
Great. So now, Prashant, I think there is more or less concurrence that the rates are not going anywhere. At least they're not moving down. So how do you think fixed income investors should position themselves in such a scenario over the next 9 to 12 months?
Sure. See, from a fixed income strategy perspective, if someone has to position which funds to invest into right now, I think if you look at the yield curve currently, your 1 year is also available at 7.5 and your 10 year is also available at 7.5. So it is a flat yield curve. Whether you invest in 1 year or you invest in 10 year, you are not losing from an income perspective. So when we are expecting a flat kind of interest rate movement over next couple of quarters, and then probably you have clarity on couple of issues like monsoons, how it's going to pan out, because we have had good monsoons for last couple of years. So we really don't know how the monsoon is going to pan out this year. So we have to wait and see then whether the bond inclusion is happening or not. So all these things probably will come in the third and the fourth quarter, or near to third and the fourth quarter. But till then, I think people should position themselves in the middle of the yield curve. That is, someone should not take a very long position at the longer end of the curve currently. If they have to position, it should be below, say, 5 year or around 2, 3, 5 years kind of duration or maturity. Why I'm saying this, why I'm talking about such specific maturities is 2, 3 reasons for that. One is, if you look at the supply of government, normally over last couple of years, we have seen that the concentration is more towards the longer end of the curve. Secondly, the yield curve is quite flat. So by investing in the near to mid term, you are not losing out anything. Thirdly, if you look at a couple of budget changes which has happened as far as, say, MLDs are concerned, or market linked debentures are concerned, or insurance is concerned, or REIT InvIT regulations are concerned, I think people will find interest into this maturities because they are giving really attractive yields at current point in time. So my view is stay in the low to mid for next couple of quarters, that is 2 quarters or so. And post that, I think the market scenario itself will tell us whether we have to extend our maturity or not.
Thank you. Okay, Sanjay, to you, I think Madan alluded to FPI flows. So I think the first question is, what is your expectation about FPI flows? Are they recovering? Are they going to recover in the next year or so? And two, what do you see the downside risk for the equity markets from here on, say, for 2023?
Sure. So, the way we are looking at it on an incremental basis, what was expected from the Fed and the tightening and the rate hikes, I think on an incremental basis, it's a lot more benign. So gradually, I would expect the flows to come back to the emerging market, more from the fact that on an incremental basis, the risk-taking appetite of the investors would be going up. The question that we should be asking, since we are all based in India and investing in India, whether those flows would be coming to India or no, while India is a part of the emerging market. And I have a slightly different stance out there. I think in the last 2 years, India as an emerging market has outperformed big time. Okay, it's not that India has grown too much; it's that the other markets have fallen significantly. So if I'm looking at on a valuation basis, India's valuation compared to the other emerging market is at a significant premium. So even if the flows come to the emerging market, India may not get its fair share of the MSCI index. So we may end up with a lower amount as compared to, say, some of the other emerging markets. And that's something that we witnessed in the last 6 months, where MSCI China has done extremely well compared to MSCI India. I wouldn't be surprised if that same trend continues. The good news is the valuations of the Indian market, no matter what people say, is in line with the last 5 years averages. And what we've seen is the earnings growth that we are likely to witness is going to be low double digit, which according to me is a good number. Maybe marginally below the market expectation, but definitely much higher than the last 5-7 years, which was mid single digit that we had seen. So while you have a case of the earnings growing in double digit, while the valuations are in line with that. So that's the way I look at overall flows. So we are likely to get some flows, maybe not as much as what the entire emerging market is getting. So let me now come to the risk part in the market, and I would like to classify it as external as well as internal. So in terms of the external factors, we continue to see the world getting polarized on account of the war between Ukraine and Russia. And this has a fallout on crude. The duration of the war itself has actually taken us by surprise. Second factor is the global central bankers are withdrawing the liquidity to curb inflation. This has a fallout on the global demand destruction. Historically, we've seen the Fed has tightened more than what makes economic sense. And it's more to do with the fact that it has to be seen to be doing something about the inflation. I know these are famous words. I hope this time it is different. I am not sure that's the way it's going to pan out. Madan did talk about India being the fastest economy, and I think we hope it's the resilience of the people who's driving this economic growth, and that should lead us to this kind of earnings growth that we are likely to witness, more closer to about 10 to 12%, and that's the way I would actually position. One thing that really worries me, and I think Madan did refer to it, no, Prashant referred to it, is in terms of the monsoon. You need to factor in that that's an unpredictable risk that we need to look at. We've had three successive good monsoons. I think the law of averages is against us, and that's something that we need to watch out. And that has a significant implication from the rural demand side, on which the entire earnings growth numbers predicted on. Yeah.
Thank you. So as we come towards probably the last few minutes of the discussion, I would like to go to the second part of the budget, which is a more interesting part, Madan. And I think we've mentioned it. Everyone's mentioned the tax proposals. So do you think the direct tax proposals are enough to boost consumption, especially for the middle class? One, I mean, is it a significant enough development? And two, I mean, do you think it's good enough to boost consumption?
No, I don't think it's going to be significant. I think the motivation is not so much as trying to give more hands to the people to spend and boost consumption. That will happen at the margin for sure. But it's more that we want to get out of this entire system of exemptions. So ideally, I think they're trying to nudge all the individuals to move towards the new system. So when they introduced it, I think in 2019 or 20, we saw that not too many people have really opted for it, because all of us are used to those kind of exemptions. And so I would look at it that way. So whatever has been done, while it has been projected as being something which will be pro-consumption, definitely it will be pro-consumption to the extent that we are getting additional income. But I think one has to work out to see what your actual income is and whether you really benefit from the new scheme and how much do you benefit. If individuals are going to get a couple of ₹1,000, I don't think that's going to make a big impact on consumption. So I look at it more in terms of trying to wean people away from the old system to the new system, so that we have a more simplistic system saying, look, there are no any exemptions, anything available. You just have a certain income, and if you're above a certain threshold, you pay whatever tax it is.
Okay. Okay, great. So from consumption, I think it took a look at the next part. You are with, I mean, you're also with Bank of Baroda, so you have a view on credit offtake. It has been trending upwards. You did mention earlier the quality of the credit offtake. So do you see it improving as we for 2023-24 at a faster clip?
No, actually, I would look at it slowing down, because we have seen historically that the growth in credit is almost equivalent to the growth in nominal GDP. So if my nominal GDP growth this year is going to be 10.5%, even if this is conservative, maybe around 11-12%. So I think that's what's going to be the growth in credit, which will be lower than the 15% growth, which we'll be probably getting for 22-23.
Prashant, do you agree with that? Credit slowing, and I mean, what's your take? How will it impact, say, the markets, at least the bond markets?
I mean, as far as credit is concerned, for us, it is debt capital market. So from a credit perspective, I feel that even if credit is flat as this year, say around 15% and all, it's going to keep our liquidity at a neutral position, and probably at a future date in time, whenever it goes, liquidity goes into the negative side, as Madan covered previously, we might see some kind of movement or some kind of actions taken by Reserve Bank of India as far as infusing liquidity goes. So I think that a combination of credit, tight liquidity, then probably a couple of other factors like large borrowing and all I consider these as static factors to keep a range bound movement on the rates in general.
Okay, great. I think unfortunately we are at the end of our time, and it's 5 o'clock. So I would like to, I think, wind up the discussion. And once again, I would like to thank you, Mr. Sabnavis, Sanjay, and Prashant, for your time and helping us decode the budget and its impact for us. I wish we had more time. And finally, I would like to thank all the viewers for joining us for an insightful discussion. Thank you, everyone, and have a nice day. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.